Let's talk about validation of a level. There are certain parameters or variables that we need to take into consideration before, in order to assess the quality of a level. And they are many: the strength of departure, the number of retests of the level, the location of the level, if it is a location or momentum type of level, what it accomplished, the type of basing, wiki or not wiki, the type of departure, a lot, the bigger picture trend, and many of these variables we need to take into account every time we look at the chart. So we'll start by the first one of them, which is let's say the one of the most important variables, and that is the strength of departure. When we look at a chart, we have to always ask the same questions over and over again. So the question we should ask when we look at the candles, any given chart, should be things like, how did price leave the zone? Okay, was it an explosive move, or was it a slow move like sumo departure? There's a sumo player, the fighters in Japan. Okay, big guys. They don't move very fast. They are strong, but they are not very fast. Were they ERC candles, extended range candles, or were they basing candles? Because the stronger the departure, the more ERC candles we have on departure, the better. So let's take a look at the chart. The strongest move up or down is always a rally or a drop and then a gap and fill gap. So here we've got a rally and a fill gap and then a rally. Then we've got a rally base, rally base, rally base, rally. ERC candles are these, closing at 80% or higher than the whole candle range from the high to the low. Okay, so these are ERC candle, all of them are ERC candles. This one ERC. These are basing candles, so we have to detect that. We also have basing candles that are ERC. Those are not typical, but they happen as well. Like, let's say, I don't see any over here, but we'll probably locate some on the weekly. Well, we'll see to them later, maybe. So we've got the as we were saying, the strength of departure. We want ESE candle, a strong move up. The impulses, they have to be, if we are trying to trade longs, they have to be up. Okay, and that will mean that the big boys, mean the imbalance is located right at the origin of the move, as you can see over here. Okay, a rally, a base, and a rally. This tells us, the institutions leave a fingerprint over there. So this is a good level to rally, to take a long at. If price would have retraced all the way back down here, but price did not retrace to that level. The level looks great, optimum, but then a higher time frame area of supply on the weekly up there, okay, is hit. So that lowers the probability of those CPs, as we spoke on the quality and the validity of the CPs, okay, on previous videos. The higher they are in the curve, and once in a higher time frame area of supply has been hit, the lower the probability they are. They tend to be removed. So how did price leave the zone? Really strongly. So we have to look at the departure of the zone to qualify the level. But not only that, as you can see, the departure is qualified here, but then we need other things like the basing and also the type of location, what it accomplished, if a higher time frame area is in control, what is the bigger picture trend, the curve, many things that you have to assess in order to define a tradable area here or not, or even here. So the departure of this area is very strong. So we need to look at this kind of departure, to the downside. You can see 1, 2, 3 ESC candles dropping from that area. That is a strong move from this area. Base drop, 1, 2, 3 candles. Okay, strong move down. So as you can see, 1, 2, and 3 candles. It takes 3 days. This is a daily chart for price to drop from 98 to 95. And it takes about 10 days or 12 days in order to retrace all the way back to that impulse. So the correction is to the upside, the impulses are to the downside. So here, same thing. Impulse down, correction, impulse down, correction, impulse down, correction. So it takes longer to correct than to create the impulse. So the market is clearly down. That's how we have to look at the charts. Okay, same here. Impulse, correction, impulse, correction, impulse. Very big correction over here. A lot of trading at the zone, and then price drop, big impulse, and then it hit an area of demand. So we forget about longs, shorts. Sorry. So departure is key. Very, very important. So assumed departure. What is assumed departure? Assumed departure is a very slow move, a lot of trade in the zone, or a stair-step lever type of levels. Like, let's say, look at this one. As you can see, rally, base, rally. Look at these candles over there. Let me zoom in a little bit. Look at this. These are 50% candles doing nothing, doing nothing, doing nothing. A stair-step ladder that is higher lows, higher lows, higher highs, higher closes. And then when price reaches that area, maybe there is an area here on the weekly, then price retraces a little bit way down and removes this stair-step ladder, this sumo departure. So they are not good at all. Okay. Let me try to look at other areas. Look at this one. You can see drop, bases, and then rallies. A lot of 50% candles away from the imbalance, and the departure here is not a strong explosive move like here, for example, a strong impulsive move, or down here, explosive move, here, explosive move. We need to look at that. They need to stand out. Okay, you need that departure to stand out, otherwise it won't be such a great level. There will be many times where that departure will not look good and the level will work, okay, and it will have a strong reaction, but that doesn't mean it is a rule. It is just an exception. Okay, that confirms the rule. Okay, so this is it about the departure. Thanks a lot.